Then in part C of the required, discuss the potential reaction of shareholders if Smartshop increases the dividend cover to 5 times in the 2019 financial year. And where possible, you must support your discussion with appropriate calculations. All right, so please note, guys, you are not only performing calculations or only discussing. You need to discuss and you need to support that discussion with appropriate calculations. And this is for 8 marks. Now, please, guys, when it comes to the potential reaction of shareholders, so where we have a company that is changing their dividend policy and we want to know how shareholders are going to react, there's a few things that we always need to consider. You always need to consider shareholder preference. You also always need to consider the signaling effect. And you should also consider whether an expectation for a dividend has been created. So if we go back to the information provided in the question, we saw that Smartshop maintained a constant dividend cover of 4 times over the past 5 years. So over the past 5 years, they were constantly paying out 25% of their earnings as a dividend. They are now looking at increasing their dividend cover to 5 times. So they are now only going to pay out 20% of their earnings as a dividend. And the reason for this is to fund the new reverse distribution model explained above. Now, the first calculation or discussion point that I would look at is this payout ratio over here. So if you jump to the suggested solution, calculate the current payout ratio and also the new payout ratio. So currently they are paying out 25% of earnings as a dividend, or that's what they did over the past 5 years, and are now looking at changing that and only paying out 20% of their earnings as a dividend. So if you look at the discussion, if the dividend cover is increasing, that means a smaller percentage of earnings will be paid out as a dividend. So 20% of earnings will only be paid out instead of 25% of earnings. So that's the first calculation or discussion point that I would look at. Then in addition to that, guys, I said to you, you always need to discuss shareholder preferences. You need to consider whether an expectation for an increased dividend has been created. And you also need to discuss the signaling effect. So let's look at each of these things. First, when it comes to shareholder preferences, remember, guys, different shareholders prefer different things. So certain shareholders prefer growth in the share price as a result of capital investments. So they would rather have the share price growing because the company keeps the money in the business to fund investments and they don't pay the money out as a dividend. Now, these shareholders would obviously be happy with the decision to increase the dividend cover and rather fund the reverse distribution model with the cash reserves instead of paying such a high dividend. On the other hand, other shareholders may prefer larger dividends and they don't want uncertain capital growth. Remember, capital growth in the share price is uncertain, guys. The share price might not actually increase. Markets might change, the company might not do well in the future, and that might cause the share price to drop. So if a shareholder is risk averse, they might prefer to rather get a known dividend today than wait for uncertain capital growth. And that is the bird in the hand theory. So some shareholders prefer capital growth, other shareholders prefer a known dividend today. And some shareholders are actually dependent on that dividend. So for example, guys, if we have pensioners, they might actually be dependent on the dividend. So cutting the dividend would impact on them negatively. So these shareholders would not be happy with the decision to increase the dividend cover. So please, always discuss shareholder preferences. Then we need to consider whether an expectation for an increased dividend has been created. And this is where a lot of your calculations are going to come in. Because we've been given the dividend over here for the last 5 years. You've got the dividend for the last 5 years. So using this information, we can calculate what the average growth rate has been during this period. So that's the first calculation I'm performing. Now remember, just as a reminder, sorry, let me jump back. If we are trying to calculate a growth rate over here, this is going to be your present value, that is going to be your future value. One of those need to be negative, otherwise your financial calculator can't perform the calculation. So make one of these negative. Make that your present value, make that your future value. Please note, guys, n is not equal to 5. N is the number of periods of growth. So we have one period of growth from 2014 to 2015, another period from 2015 to 2016, then it grows again from 2016 to 2017, and it grows from 2017 to 2018. So even though we have information for a period of 5 years over here, there are not 5 periods of growth, there are only 4 periods of growth. So n is going to equal 4. And you compute I, and that will give you the growth rate. So this might create an expectation for an increased dividend in the 2019 financial year, because over the past couple of years, dividends have been growing at a rate of 14%. What is another calculation that we can perform? We were given the expected earnings for the 2019 financial year. Earnings are expected to be 3,000 cents per share. So we can calculate if earnings are 3,000 cents per share, and if the company doesn't change their dividend policy, that is the dividend that shareholders will be expecting. So shareholders expect a dividend cover of 4 times, meaning they expect a dividend of 750 cents per share. This is, however, going to change because the dividend cover is going to increase to 5 times, which means they will only be paying a dividend of 600 cents per share. So we can calculate what this movement is over here. This is the expected dividends. Shareholders are going to expect a dividend of 750 cents per share. However, they will only receive a dividend of 600 cents per share. So calculate what the decrease is over there. In addition to that, we can also compare or calculate the movement from the prior year to the current year. In the prior year, they had a dividend of 675 cents per share, and in the current year, the dividend is actually going to drop to 600 cents per share. So we can calculate that movement as well. So let's just quickly look at all of these calculations. So a constant dividend cover of 4 times has been maintained over the past 5 years. So this will create an expectation for a dividend of 750 cents per share if they keep that same dividend cover. However, if the dividend cover increases to 5 times, this will result in a dividend of 600 cents per share. We can then compare the expected dividend to the dividend that the directors want to declare, and we can see that the actual dividend is going to be 20% lower than what shareholders expect. The shareholders are expecting a dividend of 750 cents per share, but it will only be 600 cents per share. So this is 20% lower than what shareholders would expect. In addition to that, we can also compare this year's dividend to last year's dividend. So last year's dividend was 675 cents per share. This year's dividend is 600 cents per share. So that is a decrease of 11% from the prior year. Then lastly, guys, you need to discuss the signaling effect. And remember, with the signaling effect, if a company decides to all of a sudden cut their dividends, this is seen to be imparting negative news about the future prospects of the company. So there's a risk that shareholders may view the increase in dividend cover as an indication that the company is experiencing difficulties. And if they believe that the company is experiencing difficulties, this might result in them selling their shares. And if there's an oversupply of shares and nobody wants to buy shares in Smartshop, this could cause their share price to drop. All right, so that then deals with part C of the required. Then in part D of the required, you need to discuss the errors made in the candidate's WACC calculation, and you are not required to perform any calculations. All right, so no calculations necessary. Just discuss the errors in the candidate's WACC calculation, and this is for 8 marks. All right, guys, so if you go back to the information provided in the question, this is the calculation that was submitted by one of the candidates. So we need to look at this calculation and discuss the errors in the calculation. Please note the candidates were required to calculate the weighted average cost of capital at the 31st of December 2018, and the calculation is based on this information which was provided. All right, so guys, we have been given the target capital structure of the company, so it's not necessary to calculate the market value of debt and the market value of equity. The target capital structure should be used as the weighting. However, we do need to calculate the cost of equity and the cost of debt. All right, or the candidate would need to calculate the cost of equity and the cost of debt. So based on the information provided, the cost of equity can be calculated using the capital asset pricing model, because we've got risk-free rates, we've got a market rate, and we've got beta. So let's look at this calculation first. We know if we calculate the cost of equity using the capital asset pricing model, what is the formula? We take the risk-free rate, we add beta, and that is multiplied by the market rate minus the risk-free rate. And the market rate minus the risk-free rate is the risk premium. So based on the information provided in the question, please note you are not required to perform calculations, but the easiest way to see if there's an error in the candidate's calculation is to consider how you would have performed the calculation, and then you'll know if there's an error. So obviously, guys, you don't need to actually write all of this out, and you don't need to perform the calculations, but this is what your thought process should be. So we take the risk-free rate. The risk-free rate is always the long-term rate. So the rate on government bonds is the risk-free rate, and we use the long-term rate because the WACC calculation is a long-term calculation. So we should use that 9% over there as our risk-free rate. Beta is 1.2. And then please note, guys, the candidates were given the market rate of 14%. They were not given the market premium. If they were given the market rate, they need to still deduct the risk-free rate in order to get the risk premium or the market premium, and that will then give them the cost of equity. So we can now look at the errors in this candidate's calculation. First, the incorrect risk-free rate has been used. They are using the short-term rate instead of the long-term rate, so that's the first error. In addition to that, this 14% over here is not the market risk premium, it is the market rate, so that is also incorrect. The risk-free rate needs to be deducted so that you can get the market risk premium. The market risk premium is then multiplied by beta. You add the risk-free rate, and that will give you the cost of equity. All right, so there's 2 errors in calculating the cost of equity. The risk-free rate over here is incorrect, and that is not the market premium. That is the market rate, so that's also incorrect. Then if we look at the long-term loan, Smartshop entered into a loan agreement with their bankers on the 1st of January 2016. Please remember, guys, dates here are very important, because if we need to look at any calculations relating to either the cost of debt or the market value of debt, we only ever look at future cash flows. So they were required to calculate the WACC at the 31st of December 2018. So only future cash flows should be included in the calculation. Any past cash flows before the 31st of December 2018 should be ignored. The original loan amount is 10 million rand. The interest rate on the loan is 11%, and everything is repayable in a single bullet payment on the 31st of December 2020. All right, so the period of the loan that we are looking at over here is 5 years. That is the full loan term. So let's look at his calculation. The present value is correct. That is the original loan amount. N is 5. The full loan term is used in this calculation. That is correct. Payment is 0. That is correct. There's no payments made on an annual basis. Everything is repayable in a single bullet payment at the end of the loan term. So that is why they are computing the future value, which is correct. However, when you are calculating your cash flows, guys, this would be step 1 in our calculation, where we are calculating our cash flows. when calculating our cash flows in step 1, we ignore tax and transaction costs. So he's correctly used the coupon rate, that is the interest rate on the loan. So remember, when we are calculating our interest cash flows, we always use the coupon rate. So the interest rate on this loan is 11%. That is the coupon rate, which will be used to calculate the interest cash flow. So that is 100% correct in his calculation. You don't use the cost of debt. Now, he wouldn't have made that mistake because he doesn't have the cost of debt. He's actually trying to calculate the cost of debt. But just as a bit of revision, remember, if you are given the coupon rate and also the cost of debt, you don't use the cost of debt when calculating your cash flows in step 1. You use the coupon rate. So that is correct. The 11% is correct. However, in step 1, you are supposed to ignore tax. So this should not be multiplied by 72%. That is incorrect. When calculating your cash flows in step 1, tax should be ignored. So that's the first error that he's made in this calculation over here. Then, after you've calculated your cash flows, you put all of those cash flows on the table. But this table should only ever include future cash flows when we are calculating the cost of debt or the market value of debt. So all of these columns over here should not be included in the calculation. We should only include future cash flows in the calculation. So that's another error. He's also including past cash flows. He's got the original loan amount here of 10 million rand in the calculation, and that is incorrect. This is a cash flow that happened in the past. It is not a future cash flow, so it should not be included in the calculation. But what should be included in the calculation when we are trying to get the after-tax cost of debt? If we are trying to calculate the after-tax cost of debt, remember, guys, you can only ever have one unknown. So if we need to calculate the market value, you use the cost of debt as your discount rate in order to calculate the market value. So if they want you to calculate the market value, they need to give you the cost of debt or the interest rate on similar loans or the market-related rate. And we use that cost of debt as our discount rate to calculate the market value. However, in this question, that's not what we are doing. In this question, they need to calculate, or the candidates need to calculate, the after-tax cost of debt. So if you're calculating the after-tax cost of debt, you need to be given the market value. Now, they were not given the market value, but the candidate should have asked for more information because the market value needs to be included in this calculation. We only include future cash flows in the calculation, so the current market value at the 31st of December 2018 should be included in this calculation. So that would be the current market value. So you don't include the original loan proceeds of 10 million rand because that is a cash flow that happened in the past. Instead, we include the current market value in our calculation when we are trying to calculate the after-tax cost of debt. All right, then you can see he includes that bullet payment that was calculated above in step 1. And then he calculates, I'm assuming it's a he, sorry guys, it could be a he or a she obviously. Then the tax benefit is calculated. Now the problem with this calculation over here is the tax benefit is calculated on the full amount. Now, interest on the loan will be tax deductible. However, the capital portion is not tax deductible. So this bullet payment at the end of the loan period is obviously made up of both capital and interest. Capital is not tax deductible. So 10 million rand will be the capital portion. That is not tax deductible. Only the interest portion is tax deductible. So this is also incorrect over here. This should not be based on the full bullet payment. It should only be the interest portion. Then in addition to that, guys, this is a loan. And a loan is an interest-bearing arrangement, which means that it qualifies as an instrument in terms of Section 24J of the Income Tax Act. So even if he performed this calculation correctly and he took the interest amount over here and he multiplied it by 28% to get the tax benefit at the end of the loan term, that is still incorrect because in terms of Section 24J, The company does not get the tax benefit or the tax deduction when they actually pay the interest. They get the deduction as the interest accrues over the period. So that is another error in the calculation. This tax benefit should be taken into account as the interest accrues over the loan period and not only when the interest is finally paid at the end of the loan period. Then if we move on to the final WACC calculation over here, so obviously the costs come from the calculations above, and we've discussed the errors in those calculations. Let's just have a look if this weighting over here is correct. So the candidates were given Smartshop's current debt to equity ratio and also the target debt to equity ratio. Now guys, we know when performing this calculation, you should use the target capital structure of the company. So it looks like he's making a mistake over here and he's using the current capital structure instead of the target capital structure. That's where the 55% and the 45% is coming from, over there. And in addition to that, guys, so that's the first error. The current capital structure is being used instead of the target capital structure. You should use the target capital structure. In addition to that, we also know that the debt to equity ratio does not give us the capital structure of the company. This debt to equity ratio needs to be converted into a gearing ratio. So if we convert this into a gearing ratio, we take the long-term debt and we divide by long-term debt plus equity. So if that is the target debt to equity ratio, the debt is 0.8 and equity is 1. So guys, this gives us a gearing ratio or target gearing ratio of 44%. So this is their target. So I'm just looking at how the calculation should have been performed correctly. Once we know how it should have been performed correctly, we can then just discuss the error. So if we have a gearing ratio of 44%, that means it's 44% debt and 56% equity. So that is Smartshop's target capital structure or their target gearing ratio. Ideally, they want 44% debt and 56% equity in their capital structure. And this is what we should be using in order to calculate the weighted average cost of capital. That is the correct weighting. So the errors made by the candidate first, he's not using the target debt to equity ratio, he's using the current debt to equity ratio, and that is incorrect. In addition to that, you can't just take the debt to equity ratio as it is because that does not give us the capital structure of the company. You need to take that debt to equity ratio and convert it into a gearing ratio. And the gearing ratio gives us the capital structure of the company. So that's actually what should be used in the calculation over here. It shouldn't be 45% and 55%, that is incorrect. Instead, when we calculated the target gearing ratio, it should actually be 56% equity and 44% debt. So that is using the target capital structure, not the current capital structure, and it's based on the gearing ratio, not the debt to equity ratio. All right, guys, so that then answers part D of the required. Lastly, moving on to part E of the required, you need to list some ideas of how Smartshop can give back to the local community. All right, guys, now when it comes to listing some ideas of how they can give back to the local community, obviously this is looking at their social responsibility to the local community. Please make sure that the points raised are relevant to the type of industry that you are dealing with. So in other words, what I'm talking about is we know that Smartshop operates in the supermarket and produce distribution industry, and their focus is the sale of groceries and other household products. So any social initiatives must make sense based on the industry that this company is operating in. So if you jump to the suggested solution, here are some ways that a grocery store or a supermarket group could give back to the local community. Firstly, they can help with job creation by recruiting staff from local communities around their stores. Then they should also source their products from as many local suppliers as possible. Or they should try and develop new entrepreneurs by supporting smaller local suppliers rather than large corporates. Any surplus food should be donated to charities. They should set up soup kitchens for the homeless. They should help with sustainable food gardens. They should subsidize the price of bread and other basic food items. All right, guys, so those are just a few ways that Smartshop can give back to their local community. If you came up with any other ideas, as long as it makes sense based on the industry that this company operates in, you can award yourself that mark. All right, that then brings us to the end of this question. If there's anything you're unsure of, or if you have any other points that you've discussed that I haven't included in my solution, pop me an email. Let's sort everything out before you write test 1. Thank you, guys.